We can reconvene. Thank you all very much for being here. I thought that was a great kickoff to the discussion here at Hoover today. John Taylor did another spectacular job in bringing together great scholars. I think the other thing that's really quite good about the organization is we hit on some themes this morning that I think this panel is going to take up. Just I'll bridge a few of them. One was I heard a lot about a sober view of what quantitative easing is and can be and what its efficacy was from a broad range of people. Second, what I think we all heard was that the Fed is quite constrained in the likelihood of the next recession or shock. And in that lack of monetary space, big ideas are being thought of as to how to deal with that. And the paper that John and Thomas are going to present really speak to that. The other thing that I think we heard really from a range of scholars is about the overlap between monetary policy and fiscal policy and some significant degree of discomfort about that overlap. So this is a burden being passed, I think, after a full day here at Hoover, back to our friends at the Federal Reserve when they convene in Chicago to take the breadth of these subjects quite seriously. So let me do a couple things. I'm going to introduce the panelists and then just give a couple of minutes of background on what I think is sort of a fundamental sense of the policy conjuncture to help frame the discussion that John, Monika, Thomas are going to have. So one can view the proximity of the current Fed policy stance at the zero lower bound as an accident of history, as a remnant of the crisis, or as a wise choice, the right place for us to be. So too the grand scale and scope of the Fed's balance sheet. But no matter one's priors, no matter where each of us have come down on this over the last years, the Fed finds itself with less conventional and unconventional ammunition. So what about Fed power and maybe most important, Fed credibility when ammunition is low? The credibility to act independently, to get policy right, and to explain the rationale for its actions is at a premium. And Fed credibility will be relied upon most when the economy slows or confronts a shock. So it's really good and important that John Williams, Rich Clarida, and their colleagues are asking themselves questions about reform to the existing structure. So John and Monika Piazzesi will discuss possible changes to the framework with, I think, a particular eye towards asking the question, how do we create some monetary space for them or for their successors? I had the good fortune of working with John Williams in the crisis, and there was no one with whom you'd rather be in the bunker than John. I recall his time there, and as you know, he's taken his talents east to be president of the New York Fed. My Stanford economics colleague, Monika Piazzesi, is with us too, and her work, both theoretical and practical, is discussed at least over the last several years, and certainly in my time, in the corridors at the Fed and other leading central banks. And so before we dive into them, just let me make a few introductory comments. Most of the students on this campus well know the financial crisis of 2008 and 9, but it's not much more resonant to them than, say, the Great Depression. It was big and consequential, an important chapter of American history, but the panic of that period is not something they experience. They don't show up in class remembering where they were when things happened. So for many students of the financial crisis more generally, I think we find some of them neither scarred nor scared. And so for some of us who served, like John and myself, we view their innocence with equal parts envy and concern. The past isn't even past. The regime change of the economy in the last decade, really from a crisis to a recovery to what we now call a sustained expansion, did not correspond to a big change in the profile or practice of the modern central banker. The Fed neither exited the front stage nor fell off the front page. Now, some view that monetary dominance with grave concern, some even with suspicion, but a lot of others are attuned to the polarization in the country and of our politics, and I think are relieved to see the Fed was a steadying force. And in the high-minded spirit of a modern Wilsonian, they see this cadre of technocratic policy pros compensating for the failings of much of the rest of our government. But the Fed's actions and its preeminence continues to leave a heavy mark on the economy, the banking system, the financial markets. And with its elevated status, the Fed finds itself considerably more exposed to the broader body politic. The central bank's prominence has caused its policy choices to be scrutinized through a very different lens, and its very independence to be tested. Now, the Fed's long been powerful. Setting interest rates has long mattered. And between the period of the Treasury-Fed Accord of 1951 and the crisis, the Fed's monetary powers were thought to be limited, well circumscribed. Monetary and fiscal policy were clearly delineated, and the delineation had an important difference. The conduct of monetary policy alone was largely accorded the benefit of central bank independence. So I'm going to ask two questions before turning it over to John. To what do we owe the heightened scrutiny of the Fed in recent years? I'll suggest four quick things. One, it's fashionable and true to talk about the hyper-partisanship of our times, of the divisions in our country. It's a lot less fashionable, but no less true, to believe that the financial crisis itself is of a piece with that polarization. One observes the casting of prospective nominees to our central bank in the last decade is either with us or against us. This is a troubling development for everyone in this room. Second, until the last couple of years, it was really true that the economic output, the broad unemployment rate, medium take-home pay, those improvements were more modest than we at the Fed expected during the crisis, and they were well below consensus forecasts until a couple of years ago. So blame has to be assigned somewhere in Washington, and the Fed, sitting as it does at center stage, serves as a useful, if sometimes undeserved, target. The Fed that I know has no shortage of good intentions, but the Fed is not an altogether unwitting victim of this political scrum. Third, when monetary policy makers herald their record of job creation, they risk their institutional prerogatives. Policy pros can rarely figure out the benefits or efficacy of monetary policy versus fiscal policy, regulatory policy, and trade policy. And often economic expansions owe more to the resilient micro-foundations of our economy than any fine-tuning that those of us in the room might be taking credit for. And even if the Fed merits special commendation, bowing at center stage strikes me as quite incompatible with safeguarding independence. Fourth, for most of the post-crisis period, the Fed grew the size of its balance sheet, the scope of its holdings, in order to provide more monetary accommodation. That was the rationale. In recent months, the Fed announced another big shift in its balance sheet plans. It would maintain a large balance sheet on a seemingly permanent basis. But no longer was monetary policy the rationale. The Fed justifies its new policy stance on regulatory grounds, on operational grounds. After all, the big banks need high-quality Fed-provided reserves. But what happens when the bright line between monetary policy and regulatory policy fade? What about when the line between monetary policy and fiscal policy blurs? This line crossing poses real risks. It's not about party or president. If Congress doesn't have the votes for an extension of the debt limit, why not get emergency relief from the Fed? If the appropriation process is deadlocked, call on the Fed to fund a new government agency. If housing prices are falling, push the Fed to buy new mortgages. If Congress and the administration can't agree on a new fiscal policy, pressure the Fed to provide more stimulus. Demanding central bank independence in the conduct of quasi-fiscal and quasi-regulatory policy is a break with historic norms. By custom, the Fed is granted carefully circumscribed authority to conduct monetary policy independently, not fiscal policy, not regulatory policy. And if the Fed becomes a general-purpose agency of economic policy, it will lose its special monetary prerogatives. And the printing press it keeps will be a temptation for mischief. We hear often about modern monetary theory in recent months. It might be a new name, but it's a new name for an old temptation to conflate monetary policy and fiscal policy. The Fed's monetary independence arises not by constitutional sanction, but by something more subtle, a norm. The independence requires constant vigilance, not by just everybody, but by the central bank itself. Independence is not the objective, however, of sound monetary policy. It's a time-tested, effective means to that objective, but that's not all. Like sound legal opinions from the High Court, monetary policy decisions are more important for the reasons they give, not not the results they announce. The Fed's institutional power comes from its ability not to pronounce, but to persuade. A policy decision that gets the reasons wrong gets a lot wrong. The Fed is absolutely right to change its judgment when circumstances dictate, but its rationale must be comprehensive and compelling. Recitation of the Fed's latest quarterly dot plot forecast, inspired by the Fed's workhorse models, is not sufficient in and of itself to justify a change in policy stance, nor is reference to an ostensibly settled monetary policy rule. So in conclusion, I'd just say, in my view, the scale and scope of monetary policymakers' ambitions have expanded over the last decade, yet its policy choices are narrower, as we heard at this morning's session, and more difficult, as I think we're going to continue to hear. So I'm going to turn it over to John and Thomas to sort of walk us through a new policy framework, or the possibility thereof, to begin to shed light on the new challenges, to talk about how to create monetary space, and suspect this is just the beginning of a long discussion over the course of this year about what real reform means to the Fed.
Perfect. Thank you, Kevin. And thank you, John. Really, I want to just emphasize that the way Thomas and I view our paper is really going back to the Taylor Rule paper and the insights that, John, you had decades ago about thinking about monetary policy in terms of strategies, in terms of rules, and here what we're going to focus on is really thinking about how a very low neutral interest rate and a lower bound. We don't take a stand on what this lower bound is, or zero or minus, whatever it may be, but how that changes some of the analysis and some of the conclusions about what makes a successful monetary policy strategy and rule. Now, since Rich Clarida talked about that we are not prejudging, this paper is really about thinking through, again, going back into the tradition of John and Ben McCallum and many other thinkers from the last few decades, of let's write down a framework, a way to think about how the economy works, think about how a systematic policy rule works within that framework, and what kind of outcomes you get out of that. So it's really very much in that tradition of writing on a simple model, trying to understand what the mechanisms are, and thinking through what the pros and cons of various approaches might be. This is work at the San Francisco and New York Fed, so I do have to say everything I say reflects our views, not necessarily the Federal Open Market Committee or anyone else in the Federal Reserve System. Okay, so here we go. So inflation targeting, importantly, and variations on inflation targeting, whether explicit or implicit, were remarkably successful in the 70s and 80s of bringing inflation down, going from high and variable inflation to bringing to low and stable inflation, and importantly, I think, anchoring inflation expectations. Today, whether you look at central banks in the advanced economies here in the United States, in Europe, in Asia, the challenge that many of us have faced is actually keeping inflation expectations anchored at our desired level, achieving our inflation targets, and there is risk out there of inflation expectations slipping below the desired level. This to me reflects a number of factors. One is a very low neutral interest rate, real interest rate, the experience of very low inflation the last decade, obviously the lessons learned from the effective lower bound in interest rates, and all the analysis that has been done in the last decade or so, pointing to a future where hitting the lower bound is obviously more likely than we thought in the past, and has effects on the ability of monetary policy to offset negative shocks to the economy with adverse effects for output and inflation. So what we do here is we look at frameworks, and I would say importantly, not just frameworks, but actually monetary policy rules that implement different frameworks to think about how to anchor inflation expectations and deliver improved macroeconomic performance in a context of a very low neutral rate and some lower bound on monetary policy. Okay, so what we do is we're actually using a very simple new Keynesian model, a basic simple model that says output depends on real interest rates and expected output. Inflation depends on some notion of resource utilization and expected inflation. And again, think about writing down a framework for monetary policy that is implemented through a version of a Taylor rule. And then we basically ask ourselves, in a world where you're going to hit the zero lower bound, something like maybe 20 or 30% of the time, and that has first order effects in the economy, what are the variations on a classic style, Taylor rule style of monetary policy that could improve performance, the coefficients of the rules, the optimal inflation rate, and also thinking about variations on the theme of inflation targeting, which have often been referred to as average inflation targeting, or price level targeting, or nominal GDP targeting. Importantly, and we're going to start from a world where the central bank is following a rule, and then we're going to ask, can you commit to a different policy rule? So one of the questions that often comes up in this literature is the policymakers have to be able to commit and communicate their policy strategy and rule for this to be effective. And that is what we're assuming, but through the analysis you'll see the importance of this ability to commit to future actions play out in the simulations of the model and kind of how all this works out. So we're going to start with the assumption that the central bank actually doesn't have the ability to commit to future actions, and then we're going to relax that assumption and see how far that takes us. Now, importantly, as the Taylor rule simulations from back in the 80s and 90s first taught us, all the literature on monetary policy strategy have taught us, it's not just the actions that you take at any given point that affect macroeconomic outcomes. It's really the execution of a coherent, consistent strategy over time that is very important. It's important for the formation of expectations of inflation, in expectations of interest rates and output. So really the right way to think about what we're doing in this paper is when you're at the lower bound, there's nothing you can do. You just cut rates to the lower bound. That's the constraint you're under. It's really the strategy and the execution of that strategy you take in times when you're not constrained that affects the behavior of expectations, affects the behavior of the economy. A couple of things that we find from this very basic analysis from this model is that if you really want to come up with a modest kind of, if you will, a twist on the Taylor rule, changing some of the coefficients or parameters of a standard Taylor rule, the best way to do that in terms of achieving your goals with a lower bound and a low neutral rate is really just following something like average inflation targeting, which is, as I'll talk about, basically says you're going to be under your inflation target in bad times, so therefore you purposefully aim to be above your inflation target at good times, and on average get to your target. Other modifications of Taylor rule don't do nearly as well in this environment. We then go on to talk quite a bit about what we call dynamic strategies. These are strategies that have more of a commitment to future policy actions. These are the makeup policies that were just claimed to not work earlier today, but I'm going to talk about them anyway. And what these are policies, they're more like a strategy that says that after you've had a zero lower bound or other episode, the policy adjusts to that fact to try to affect inflation and interest rate expectations and give the economy a boost that it otherwise wouldn't have to help stabilize inflation. So I'm going to show a lot of equations here, but I'm just going to talk through it because this is actually a paper we're going to go through a lot of math and everything, but really the main points are, I think, easy to describe verbally. The first thing is it's a very simple model where output or inflation depends on expected inflation and some notion of an output gap, and we're going to allow for a shock that moves inflation around. That's this mu shock. We also have the output gap determined by a standard IS equation, where output depends on future output, and some notion of where the real interest rate is relative to a neutral interest rate, which we call R star, which we take it to be as given. That's the long-run neutral interest rate. The central bank has a standard dual mandate style objective. We want to stabilize inflation around the target of zero. We're just assuming a zero inflation target just as convenience. You can have a higher inflation target as we show. And you want to stabilize output around its natural rate of output, or where the economy would gravitate to in the absence of shocks. The important point with a zero lower bound that's different than, say, some of the analysis that was done in previous decades is the zero lower bound is an asymmetric constraint on policy. What that means is in good times, policy reacts just as a monetary policy reacts as it normally would. In bad times, a negative shock, you're constrained about how much you can cut interest rates. And that creates an asymmetry in the monetary policy response and also how the economy behaves. So it's important when we look at, or it's helpful when we talk about what is happening in our economy, to look at both the mean rate of inflation and output, but also the variance around that mean. So that you'll see a lot of our analysis highlights, are you hitting your inflation target on average, and then what's the variance of inflation around that in output. We're going to assume a lower bound ILB, which could be 0, it could be positive, it could be negative. Putting in a negative lower bound on interest rates all along the lines that Kent Rogoff and Andy Levin and others have talked about, we could implement that in this model. That would obviously reduce some of the effects of the lower bound. In this model, optimal monetary policy under discretion, if you just said to the policymaker can't commit to future actions, what would you do, is actually represented by a version of a Taylor rule, which is shown on the bottom of the slide. And that basically says there's an intercept in the rule, which is theta 0. You respond to expected inflation, and monetary policy leans against the wind, against shocks to supply, which are mu, and epsilon, which is a demand shock. So this isn't exactly the way John wrote it down in the early 90s, but it captures the flavors of a Taylor rule. You have an intercept, which reflects this R star notion. You have in your inflation target, you have a response to expected inflation, and you're leaning against the shocks that occur because you're trying to stabilize the economy. Now, what's interesting about this is that, in this very simple model, monetary policy is pretty straightforward without the lower bound. If a demand shock comes, you offset it. Economy stabilizes very nicely. If a supply shock comes, you lean against it, and you get a nice optimal mix of the trade-off between inflation and output. So this is the simple world of complete certainty, no lower bound. Monetary policy is pretty straightforward. So what we do here is we're going to introduce a lower bound. We are not going to allow for other monetary policy actions like QE or other type activities. We're only going to say there's a lower bound in interest rates. You can't cut interest rates below that. Otherwise, you're not constrained. And then we're going to look at a policy being just following a monetary policy rule. Okay. So in this very simple model, where we start with the optimal policy under discretion, you can solve this model out with pen and paper. And what you find is a very basic insight of the lower bound. And that is that there's basically two types of behavior of this economy. One type of behavior is when you're away from the lower bound, and the economy behaves, which we say is if unconstrained, and this is the inflation equation, which basically the economy behaves as you would expect in the model without the lower bound. So inflation depends on expected inflation, it's affected by the interest rate decisions, it's affected by the dynamics, but basically it's what you're used to from before. And second is if you're at the lower bound, there's this kind of bifurcation in the economy. Interest rates are set at the lower bound, and the economy behaves slightly differently. All the same equations, it's just the way it shows up. And importantly, what comes out of this is when you're away, when you're at the lower bound, you're constrained, inflation is going to be significantly below your target level because you're constrained. It's lower than you would like. So if you have a negative demand shock, inflation is going to be low. But if you're unconstrained on the upside, if you have a positive shock, you're going to be fully or optimally offsetting that. And that asymmetry is going to immediately tell you that the average inflation rate in this simple setup with the simple policy rule is going to be below the target level. This is arithmetic built off a simple model, but it's basically the arithmetic that's been identified in every paper that's ever been written is if you just follow a Taylor rule like this or any kind of policy rule like this, the fact that the lower bound is constraining your actions means the average inflation rate will be below your target. Inflation expectations will become anchored at too low a level. I'm not going to talk about this issue of multiple equilibria and everything. That's all in the paper. Importantly, when you go through the math here, it's the expectations, even when you're in a good time like today, and you're away from the lower bound, what's happening in this model is, people who live in this world realize, well, yes, we're not the lower bound today, but maybe next year or the year after, we could have another negative shock, be at the lower bound, the central bank can't offset the shock, and inflation expectations are going to be lower because of that. So So it's a world where everybody is thinking through, we could be at the lower bound next year or the year after, and that's having an important effect on people's beliefs. So this is a world where, in the simple model, inflation can be well below your target. You want to do something, A, to maybe find a way to get back to having inflation expectations anchored at the appropriate level. And you think also maybe, is there a way to offset some of the effects of the lower bound? So we look at three basic classes of approaches, and there could be effects on the policy rule. The first is to change the coefficients of this Taylor rule, change how much you respond to expected inflation or shocks, or also possibly change this intercept of the policy rule. And so we're going to look at a couple examples of those. Then we're going to talk specifically about this issue of average inflation targeting, which has gotten a lot of attention, and the static version of that, which is basically it's a Taylor rule where you adjust the intercept of the policy rule down, basically boosts the economy in good times, so output and inflation are higher than target, knowing that when the bad shocks hit, you can't fully offset that, and you can try to achieve a good average inflation rate. And then we're going to talk from then on about dynamic policy rules. Going back to a paper that Dave Reifschneider and I wrote 20 years ago, is thinking about taking the Taylor rule and trying to do some of the makeup policies. If you're constrained at the lower bound, to adjust your Taylor rule to try to make up for the constraint from zero or the effective lower bound. And finally, we'll talk about price level and temporary price level targeting. Each of these policies requires, I would argue, increasing amounts of commitment and increasing amounts of deviation away from a standard Taylor rule. Changing the coefficients of the Taylor rule, that's probably with that same class of policy approach. Moving to a dynamic strategy like Reifschneider, the rule that Dave Reifschneider and I came up with, that's more like forward guidance and more of a complicated strategy. And obviously temporary price level targeting you can think of as requiring commitment to a significantly different strategy from the standard Taylor rule. So let me just talk first about some ideas about why would you want to change the coefficients of the Taylor rule because the lower bound. Well, the problem goes back to this issue of inflation expectations getting anchored too low. And that's happening because you're hitting the lower bound a lot on the downside, but there's nothing stopping you from raising interest rates when times are good. So one idea, which isn't an optimal idea, but something that helps illustrate this, well, say you've put a symmetric upper bound on interest rates. You just said, okay, we can't lower interest rates below 0. Let's say you can't raise interest rates above 4%, just to get understand the mechanism. Well, that complicates the analysis quite a bit, as we talk about in the paper, but it actually achieves this goal of making inflation expectations right back on target. The constraint that you can't cut rates too much is perfectly offset by the fact that you won't raise interest rates too much in good times. You no longer have this asymmetry in the economy, and mean inflation goes back to 0. The problem with this policy is that you're letting these big shocks, say a big demand or supply shock, completely pass through to inflation and output on the upside. That makes the economy less stable and actually raises the variance of the economy. So these ideas are interesting because they're really playing on the idea that I got a problem with the mean, but by getting the mean inflation rate right, they're actually making the variance much higher. And that's not a good way to do monetary policy, at least in our framework. We also look to dampening the reaction to shocks. Same thing happens there. It gets the mean inflation rate closer to the target, but it's allowing these shocks to pass through. The economy is much more variable. And again, in an objective function like we have, you care about getting the mean right, but you also don't want a lot of variance. So we find that these policies, they improve on welfare a little bit, but they're suboptimal. So in fact, what we show mathematically in this model is a simpler way to get the mean right that doesn't allow the variances to go up is to do a static intercept average inflation targeting adjustment. So let me talk about that. So in this toy model, it's very easy to do the math. Literally pencil and paper, or my co-author would say Mathematica, which is I think a modern version of pencil and paper. But what you can do is you can actually derive very simply in the setup. For example, the thought experiment we said is take the Taylor rule, say that you have, in this case we look at supply shocks, and then ask how much would you have to shift this intercept just to make mean inflation zero. And that's this formula here. I'm not saying this is optimal, but it's a nice way to think about how to think about this issue. If you're doing average inflation targeting, how much do you have to boost inflation in good times to offset the negative effect of inflation from the lower bound? And what we show here is that normally in the Taylor rule, the intercept would be R star, this neutral real rate. Here what we show in just a pen and paper is that you would want to lower this intercept, which is the same as basically boosting inflation because it's lower interest rates in good times. You would lower it by this amount in the parentheses that's squared. And what that amount is, it says it depends on how much R star is from the lower bound, in other words, how much policy space there is, and also how big are the shocks, how often do you hit the lower bound. So the way this model works is if you're hitting the lower bound a lot, or either because you have very little policy space or the shocks tend to be large, that's a time when you're going to need to lower this intercept more and basically aim for a little bit higher inflation in good times to offset the negative effects of the lower bound. Now, that's a very simple kind of change to the Taylor rule. It's still following a rule period by period. It just has a different coefficient. Now, you still have the asymmetry in the policy, so it doesn't perfectly offset the shocks in any way, but it definitely gets the mean inflation right. And what we're able to show in our analysis is this approach of just shifting the intercept dominates doing other changes to the Taylor rule in this context. So really you want to leave the coefficients of the Taylor rule where they would be otherwise, and if you were just to make one change, you would change the intercept, which is what we call static average inflation targeting. Okay, so I'm going to just show you a very simple picture of a supply shock, and the black dots are the ones that happen, see if I can get this right from here, are what happens when you're not constrained. And so this is a shock that pushes inflation way down, and you're trying to fight this decline in inflation. You would love to see the economy kind of react with very low real interest rates to push inflation back up. You're constrained by the lower bound. And the red versus the blue here is just showing you with this average inflation targeting, you do a little bit better, both on the response to the shock, but you also have this mean inflation right. So I won't dwell into all the simulation results, but the basic idea is it doesn't totally undo the restrictions of the lower bound, but it at least does better than if you didn't change the intercept. And I'll skip that. Now, one of the things that's interesting, actually, I'll show this one. This is interesting. A lot of people ask me about this average inflation targeting. What does it actually look like in kind of like in the real world? And this little simulation, I think, captures this idea. This is a positive demand shock. So just imagine an economy, you get a big increase in fiscal spending or something that causes the economy to grow for a year a little bit faster. Now, the optimal monetary policy in this model is to raise interest rates, offset the demand shock, keep output at potential, keep the economy at full employment, and that will keep inflation on target. So this is a case without a lower bound. The optimal policy would just be completely offset it. The shock doesn't pass through to the economy, and that's shown by the black dot. What happens under the average inflation targeting, the red dot, is you actually allow inflation to run a little bit higher and output to run a little bit higher in this period of the positive demand shock. Well, to understand what's happening here, it's not that you're accommodating the demand shock. It's actually that you're letting output and inflation always run a little bit higher in periods when the economy is strong. So in this example, inflation is running about 20 basis points, see if I'm reading the right thing. No, just about 10 basis points above the target. And that's just a feature of this economy. So in times where you get the economy's doing well, you're away from the lower bound, inflation will run somewhat above the target, but not a lot above the target, knowing that it's offsetting times when inflation is running below the target in the negative shocks. Interestingly, you can also see why the standard policy rule under discretion doesn't work well. Because in this example, inflation is running below target all the time. In this calibration of our model, the inflation expectations are anchored at a 1/4 percentage point below target. And even when you get a positive shock, even in a good time, inflation doesn't get back to the target level. Okay, so let me talk about the dynamic average inflation targeting. The first example was just change the intercept of the Taylor rule, allow inflation to run a little bit above target on good times, knowing that it will be below target to get the same mean inflation rate. By the way, this is an idea that was has been in papers for a long time. This is something you need to do to get mean inflation right, but here it's more of a strategy. But that strategy only undoes one part of the zero lower bound problem, and that's the mean. Other strategies have been designed to deal with the fact that the economy doesn't perform as well because of the lower bound. And one idea we had, Dave Reshner and I had back in the late 90s, was this idea of a makeup rule, which is to take the Taylor rule as given, and then just say, after a period of being at the lower bound, you will follow that purposefully with a period where you keep interest rates lower for longer than you otherwise would. Now, we actually have a mathematical formula in our how we do that, and basically the formula works like this. You keep track of how much above your desired interest rate you've been with every passing month. You accumulate that up, and then as you come out of a period of being lower bound, as the economy recovers, you actually you pay off, in a way, that accumulated misses of your policy actions because of the lower bound, and make up for those exactly symmetrically. So if I was in a lower bound period where I wanted to cut interest rates to -2, but I can only cut it to 0, that would be 2 percentage points. So I would then adjust policy in the future to offset that. Now, that does require a commitment to a policy of lower for longer. You can think of this as forward guidance. It's a policy rule that you follow every time, and it's also something that you'd have to communicate effectively. What's nice about this setup is it's still a Taylor rule, it's still inflation targeting, but it does have the nice feature that in models like this, or even in more complicated models, it naturally offsets this issue of the asymmetry of the economy. Because it's offsetting the effect of the lower bound over time, you get mean inflation that's 0, and you also get that the variance in response to shocks is much less. So why does a makeup policy actually work very well? It's because when you're at the lower bound, the thing you want to do is you want to improve financial conditions. You want to lower long-term interest rates. Going back to what Andy Levin said, you want to get mortgage rates down. You want to get car loan rates down. How do you get car loan rates down? You basically have promised to keep short-term interest rates low, and that will push long-term interest rates low. Forward guidance, by the way, in 2011, if you doubt that it worked, you look at the paper that Eric Swanson and I did, or others have done, when the Fed actually did announce that we wouldn't raise interest rates for 2 years and later modified that to be even longer, long-term interest rates did come down, mortgage rates did come down. I think the evidence on a strong commitment to policy actions has proven to be effective. But here, it wouldn't just be forward guidance in terms of making an announcement. It would be part of a monetary policy framework and strategy, and a policy rule that executes on that. But the way it's working is when the economy is at the lower bound, you're promising to keep interest rates lower than you otherwise would. That lowers costs of funds, it boosts financial conditions, and that helps stimulate spending and obviously inflation. So that's the mechanism by which that works. So the other two strategies are price level targeting and all their variants, and these have been around for decades. There's temporary price level targeting that my colleague Charlie Evans first talked about in 2010, and Ben Bernanke has written about in the last couple of years. There's nominal GDP targeting as well. All of these work in the same way. It's exactly like I said with the Reich-Schneider-Williams rule. You're basically promising in the future, after a period of the lower bound, to keep interest rates lower for longer in a way to push inflation back up. In that way, lower costs of borrowing costs, get output to grow faster, and get inflation to pick up more quickly. But unlike the rule that Dave and I came up with, which is based on really just a lower bound issue, this is really talk about price level targeting more generically. So we'll talk about some of the issues with that. So price level targeting, the way we're going to implement that is we're going to take the Taylor rule. We're going to do exactly as John, our version of the Taylor rule, and then add a reaction to the price level, where the price level is assumed there's a target price level that's exogenous, and when the price level rises above that, you raise interest rates. When the price level falls below it, you cut interest rates. We'll put on the same lower bound as before, Interestingly, in this model, and a lot of models like this, price level targeting can do very well, even absent the lower bound. So I want to make sure that we try to understand, is it doing better because of the lower bound or because of this commitment to these future actions? So in this model, price level targeting is close to optimal. So I want to make sure that we clarify, kind of where price level targeting is an additional benefit at the lower bound. The temporary price level targeting is from Evans and Bernanke is basically that you on normal times you just do a normal policy rule, but if you hit the lower bound and the price level is below the target, you make a commitment at that point to get the price level back to its target level, and that's a version of temporary or kind of opportunistic price level targeting. That in negative cases you'll keep interest rates essentially at zero until the price level gets back to the original level. The nice thing about price level targeting is that standard price level targeting is it gives you mean zero inflation by construction. Here, one of the issues with temporary price level targeting is it doesn't necessarily give you mean inflation at the target. It could be above or below, because basically you're layering on. It's pretty complicated, right? You're starting with a situation where you have the zero lower bound on one side, and now you're putting a nonlinear rule on top of that. And you can calibrate this to get to mean inflation, but it's a little bit more complicated setup. So how do these work? And this is a chart that is very complicated, but I think I want to make 2 points. This is a response to a large positive supply shock. And so that's a good news shock in a way. Inflation goes up, the monetary policy responds to keep inflation from going too high. What happens here is all these rules, the Reif-Schneider-Williams rule, the temporary price level targeting, they're doing a similar thing because they're away from the lower bound. They're kind of they're behaving very similarly. The one difference is that the price level targeting rule does not have bygones. So if you get a positive supply shock in 2015, and now you're making policy decisions today, you're still responding potentially to keeping interest rates high to get the price level back down. So the price level targeting does not have bygones. It keeps track of all the shocks to price levels, and you're carrying these with you until you fully offset them. The temporary price level targeting and the Reif-Schneider-Williams rule here, in this case, don't have that flavor. So basically, you respond to the shock, and you go roughly back to baseline. Now, in the negative supply shock, this is where you get the action because of the lower bound. And in this case, what's interesting is, again, these rules are behaving very similarly. They're responding not only to set to the interest rates to zero or the lower bound, but they're promising to keep interest rates lower. In Reif-Schneider-Williams, it's saying, I want to keep interest rates lower until I've made up for the lower bound episode. I want to undo that damage. The price level targeting rules, whether temporary or permanent, similarly are doing that. They're saying we've had an episode of the lower bound, prices have fallen, I need to fully make that up and get the price level back. So what's interesting about this is, relative to the static rule or the discretionary rule, is all of these are basically doing the same thing. There are distinctions between them in terms of how do you describe them, how do you execute on them, and thinking through all of the aspects of it, but they're working through the same mechanism. The mechanism is, when you're at the lower bound and you've gotten hit by a negative shock, you're basically promising to keep interest rates lower for longer and do it in a way that will stimulate the economy. Now, interestingly, these policies also have effects in all periods. So we look at a little example of a large positive demand shock, and you might think that these wouldn't be that different in that case. But you have to also realize that the economy behaves a little bit differently depending on what your policy strategy is. And in this world, everybody's thinking ahead. We could be hitting the lower bound in the future. Obviously, you have a past history that you're bringing with you with this price level. And so there's some modest differences here, but it's really on the negative shocks that you see the big effects. And here's the classic case, because I think that despite my disagreement with John Cochran's view that everyone at the Fed only thinks about demand shocks, because we spend most of our time thinking about supply shocks, in fact, but the demand shock, I think, is the one that we worry about with the lower bound kind of the most. And so why? And that's because inflation and output both fall way below the desired levels. There were definitely supply shocks happening all the time, but let's think about the demand shock. And this is where these dynamic policies really do perform very differently than the static policies. And so the example you can see in the lines in the top left-hand corner or top right-hand corner for that matter, on the right-hand side is the output gap. And under the standard policy or even average inflation targeting, you get hit by a huge demand shock, the economy falls into a recession, inflation falls because you can't respond as effectively as you want. What you see in these dynamic policies is because of the commitment to keep interest rates low for the next year or two, because of the policy strategy that just delivers this, you get a much smaller decline in output. You actually get overshooting later on, which is a feature of these policies, that if you're promising to boost the economy after the recession is over, obviously you're going to have the economy overshoot somewhat, but that's healthy because it helps build a more positive reaction to the economy. And again, looking at the inflation responses, all these policies actually keep inflation very close to the target throughout this period. So they're not only doing well in terms of getting the mean near the target, but are really reducing the variance of inflation in response to shocks. So this is the way we summarize in this very simple setup, and we're not putting any numbers on this because it's kind of more conceptual. It's an ordinal ranking. And this is the loss under supply shock. So the higher the number, and there's an x-axis, which is the parameters of these price level targeting rules. But the basic idea is if you have discretion, if you don't deviate from the standard Taylor rule that's optimal without the lower bound, the loss is on the blue line. That's kind of just a marker of where we start. Going to the static average inflation targeting lowers the loss by lowering the mean inflation rate, reducing some of the variance from the negative shocks from the lower bound. Going to the RW policy not only gets the means right, but also reduces the variance quite a bit. And you can see this temporary price level targeting actually can do somewhat better than the RW rule. But part of that, part of that is due to this kind of baseline feature that price level targeting in this rule is actually an optimal strategy, so it does better than other rules. So a good way to get at that is if you look at what happens to in demand shocks, because in this model for just a pure demand shock, the optimal policy is completely to offset the shock immediately. So there is actually no difference between a commitment policy and a discretion policy. Price level targeting isn't better absent the lower bound. And this is where I think you actually learn the important lesson of this analysis is that in a demand shock case, getting the average inflation right is beneficial for the reasons I've said. It gets the mean right, and it also reduces some of the variance. It helps you offset some of the shocks. But importantly, this RW policy, the price level targeting, the temporary price level targeting, if you calibrate the parameters right in the context of this Taylor rule, they all work about almost exactly the same. They're all doing the same thing. They're promising lower for longer. They're doing it in different words and different implementations. But because they're trying to do the same thing in the same way, in fact, in this model, if you calibrate them correctly, they're all equally effective. So that really gets to the question of credibility, communication, commitment around the policy. So the economics of these differences are very small. The real differences, I think, from a practical point of view, is how could you best implement and execute on them rather than conceptually. I will say that this is a very toy model, but the work that's done by Bernanke, Kiley, and Roberts, work that Dave Reifschner and I did a long time ago, and many others, have made and complicated in other types of models these very similar points that these results are not specific to this model. I think this very simple model helps you understand what's going on because complicated models are complicated. I'm going to finish up here. I do think there's this natural ordering of thinking about alternatives, and they tend to be ordering about starting from normal flexible inflation targeting and thinking about relatively small deviations of a Taylor rule versus thinking about much larger shifts in strategy and the issues around commitment and communication around that. The last thing I'm going to say is, and I know this is a question I get asked a lot, is you looked at, well, why not just raise the inflation target? And so we actually looked at that in the paper. In the paper, the optimal inflation target for the RW policy for the price level targeting is zero, the baseline thing. These policies, you would not raise the inflation target. For the average inflation target in this model, you would raise the inflation target a little bit, but the charts I'm showing you, the ordering I'm showing you, wouldn't be any different. That effect is secondary. So I didn't talk about it today, but that's all in the paper. Thank you.
Great. Thank you, John. Monika?
Thank you. Thank you very much to the organizers for giving me a great paper to discuss. As I was reading the paper, I thought how deeply appreciative I've been of the fact that I'm reading a paper by my policymaker, by John, who is actually sitting on the FOMC and making the policy, and here writing down in a coherent way how he thinks about policy in a low interest rate environment. And so the model, so the question is important, is for policy is what do we do if interest rates stay low? And the way this paper is addressing this question, it's using a standard new Keynesian model for inflation, pi and the output gap x. That model has two equations, a Phillips curve and an Euler equation. R star here is the real rate in the long run, and mu is a supply shock, and epsilon is a demand shock. So this is a very simple way of analyzing monetary policy. So now we can ask, what happens if there's a lower bound on the short-term interest rate, IT? So imagine that IT is constrained from going negative, so it has to stay positive or at zero. And so the question is, in that world, what should monetary policy do? How should we set the short-term interest rate? And the answer that the paper gives is the Fed should commit to rules that raise inflation expectations, broadly speaking. So the lower bound, in the zero lower bound environment, that prevents policy from cutting rates in response to bad shocks. So you can't cut below zero. And then we can think about what happens in that world with discretion. An optimal policy in that world leads to low inflation expectations. Policy can then increase these inflation expectations by committing to a rule. And then the paper goes through a number of rules that actually do the job. So many rules would do the job. Starting from an optimal discretionary rule, you can imagine using dovish policies that just respond less to shocks. Or you might imagine using static average inflation targeting, which translates in this world to just using a lower intercept in your Taylor rule. An alternative might be the Reif-Schneider-Williams rule, which responds to past deviation from the inflation target. So it's a dynamic rule. Or you might think about doing price level targeting. And in this particular model, price level targeting seems to work out best. But all these rules achieve the same goal of just lowering policy rates for a longer time, especially after bad times. So as I was reading the paper, I was thinking, why do we think that the short-term nominal rate even has a lower bound? And this goes back to the discussion we had in the previous session. So the typical argument that you would make in a new Keynesian model would be to say, well, the nominal short rate is the interest rate on savings. The government provides cash, and there's zero interest on cash. And so if the savings rate drops below zero, households will go to the bank, withdraw their savings, and start holding cash. That's the typical argument for why you can't go below zero. And so then, if you imagine modern economies, how monetary policy works in modern economies, well, it's banks that are providing these savings deposits to households. And the banks manage these deposits by paying each other. So among banks, they pay each other with reserves. And the way this is done in all modern economies is that the government provides a gross settlement system for reserves that banks use to pay each other. The banks have a reserve account at the central bank, and then the central banks can choose to pay interest on these reserves that banks have at the central bank. Any interest that is getting paid on reserves is making this deposit production cheaper. So it acts like, to the production of deposits to households, it acts like a subsidy for the institution that is producing deposits for banks. And so the key questions for the world is, can the central bank actually pay negative rates on reserves? And then the secondary question, do banks pass these negative rates on to households and firms? And so I thought I was going to show some evidence from Europe. And so this graph is from a paper, recent paper by Haider, Saidi, and Shepens that is forthcoming in the Review of Financial Studies. It has this very nice picture of what happened in Europe with the deposit facility rate. That's the gray straight lockstep function that you see on the bottom in this graph over time since 2009. And so you see that that's basically interest that the ECB pays on reserves. And you see that going negative in 2014. Other rates also go negative, like the 3-month Euribor rate also goes negative. That's a rate that banks pay to each other. So importantly, these are rates that banks face. So banks in Europe face negative rates. What happens to, when banks face these negative rates, what happens to rates that firms face or households face? And so the upper graph is the distribution of deposit rates that households receive on their deposit accounts. And the gray bar are from 2013, before interest rates went negative. And then the white bars is the distribution of rates that households received when rates went negative for banks. And so you see there's no mass on the left of zero. No bank chose to pass on negative rates to households. In the lower chart, you see the distribution of deposit rates that non-financial corporations received on their deposit accounts. And so again, gray shaded bars is the distribution in 2013. White areas is the distribution in 2014 when interest rates were negative. And so now you see that some banks dare to pass on negative rates to firms, not to households, but to firms. And so the question, is there a zero lower bound for the nominal short-term interest rate? In Europe, at least, we can say banks have been paying negative rates on reserves. Not just the ECB, that was the evidence that I just showed you, but also Norway, Denmark, Sweden, Switzerland, and Japan have all used negative rates on reserves. And the key question then becomes is, do banks pass on these negative rates? And so far, at least from the evidence from Europe, we can say it seems that the answer is yes, they pass negative rates on to firms, but not to households. And that raises the question of why that happens. Why don't banks just pass on the negative rates also to households? What's the reason for that to happen? In the setup that John was describing, that's a constraint, that it just can't happen. The short rate just can't go negative. And so the question is, what is the foundation of that constraint? It might be behavioral. Maybe households don't like having negative rates on their deposit accounts. But the key question is, what is that constraint doing? And how do we think about optimal policy in an environment where whatever it is, why households don't seem to be accepting negative rates, where that is going on, how does optimal policy look like? And so I can interpret the findings in this paper as basically saying, here's how you think about monetary policy in an environment where there is a constraint, whatever it is, there's a constraint on the household side, they won't accept negative rates, which seems to be consistent with what we see in Europe. Then, as you think about how this production of deposit works, it made me rethink the question of why do we, in the US, pay interest on reserves? Interest on reserves is something that came about in 2008. Since then, the Fed has been paying interest on reserves, and it's an interesting question to ask why we're doing this. There has it's clear that it is associated with the wealth redistribution from taxpayers towards those who own shares of banks, because it's more profitable for banks to be in business if they get paid interest on reserves. So it's an interesting question of why we switched to that system. And in particular, now that we've had a lot of QEs and the reserves have been doing what I'm showing here on this chart, which they went from essentially 0 to, after the QEs, large numbers, trillions of reserves. So we now have banks that have plenty of reserves. Of course, now it's difficult to say we're not going to pay interest on reserves because we've just flooded the system with reserves. If the Fed were to stop paying interest on reserves today, that would cause an issue for banks. But it's sort of self-inflicted, where we got here because we increased reserves before. And I still think we have to answer and address the question why it is that we're paying interest on reserves. And then the focus in the paper is about interest rate policy, which is important. What I think is also important is that we have a discussion about the second policy tool that the Fed has, which is the size of its balance sheet. Now that we're thinking about a low interest environment, we have to think whether it's useful or not to reduce the amount of reserves in the banking system. And in particular, as we're thinking about that, we can start thinking about negative rates on reserves. If there's going to be less of reserves, it's not going to be that painful to think about policies that in the US would reduce interest on reserves to negative numbers. When you start being intrigued about negative interest rates on reserves, you immediately think about what's going to happen in the longer run. The European experience is relatively short. So Europe has started doing this in 2014. A key question going forward is how are things going to change if rates are going to stay negative on reserves? For example, as you think about the way banks do their business using this gross settlement system that is provided by the government, I could imagine that banks start thinking whether that is a good idea to have reserves in accounts at the Fed and then pay each other through the system, which is very costly when interest rates on reserves are negative. They could be designing alternative systems, and we're going to see those in Europe. If interest rates stay negative for longer, we're going to see alternative systems where banks try to minimize the use of reserves and where they might pay each other in cash. They will try to net maybe during the day and then just have cash deliveries because that's the cheaper way of running their business. And so we will see in the longer run changes in the banking system if we go that route. But I think we should be considering that route as a serious alternative because interest on reserves is something that benefits banks, and we need to think about whether that's what we want to have.
Thank you, Monika. Let's turn it over to questions. We started 15 minutes late, so we're going to go use our full hour and 15 and go until quarter after the hour. Krishna, we can start with you.
Thanks very much. So, John, you presented a sort of hierarchy of effectiveness in the model, but you also early on made the point that, in a sense, the challenges regarding credibility and commitment also escalate in the same order. My own view, just based on speaking to lots of market participants, is that a framework review conclusion that promised to behave differently and contingently in the future would be regarded as having relatively little credibility today in financial markets relative to changes which involved you actually changing your real-time observable behaviors today. So what I wanted to ask is, first of all, how do you think about evaluating that trade-off that you presented between the efficacy in the model and what you're asking by way of the central bank's credibility and forward-looking inflation expectations formation process? How are you going to evaluate that? And should we think of it as an either-or could we think of a situation in which behaving somewhat differently in the present could enhance the credibility of promises to take firmer commitments in the future contingency LB events.
So on your question of how will we evaluate these trade-offs, my answer is carefully and thoughtfully and deliberately. It is the Federal Reserve. So, I agree with your point. It's easier to teach people what your reaction function is every day when you conduct yourself consistent with that reaction function. That's I think one of the strengths of being consistent and coherent in your strategy. And when we think about these contingent strategies that only happen after lower bound episodes, say the temporary price level targeting of Evans and Bernanke, or the Reifschneider-Williams, or some variation of that, the challenge there is you're saying, hey, 7, 8 years, whenever, this is what we'll do. So I think that the way I think about your question, obviously, again, I'm speaking for myself, and it's really more conceptually rather than, what will the answer be, is first of all, you want to be just very clear on what your goals are of your framework and your strategy, and what you're trying to achieve, and how you understand that. And from that, and communicate that, obviously, and from that are really the operational issues, or maybe the implementation of this. So the reason that Thomas and I described average inflation targeting as static and dynamic is I view, the Reifschneider-Williams thing as actually being a kind of a version of average inflation targeting, and of course the static one as well. So the strategy might be, for example, just to, hypothetically, is to say we want the average inflation rate over the longer run to be at 2%. That means that in periods when we're away from the lower bound, we would expect inflation to be somewhat above our target relative to that 2% goal. And then there might be the execution issue as well. How exactly would you carry that out? And then it could be more of a, in our kind of policy reaction function way, it would be following something along the lines of one of these variations of these rules. So I think there's a way to kind of get from a strategy framework to a desired outcome to now we're going to talk about the nitty-gritty of what's your policy reaction function look like. But I agree with the premise that some of these are easier to do successfully when people have a lot of muscle memory around them. And I would just say it's not just market participants, it's the general public, and it's us. The more we do consistent monetary policy, I'm not talking about just today, I think the more that just becomes ingrained in people's expectations and behavior.
John Cochran? When you're done, you'll pass the microphone right in front of you. So we'll take 2 questions and then a couple of answers.
That's a wise idea, because I see lots of questions want to be asked. As much of a fan as I am of price level targeting as you are, the models that you're using have this interesting property that promises farther in the future have bigger effects today. I tried this out last week. I asked my wife, if I promise to clean the dishes 5 years from now, will you cook dinner for a month? And she said no. And there's, as you know, there's an industry now devoted to trying to repair that feature of the model. So I would suggest at least considering toning that down if possible. And it may lead to the conclusion that, the Friedman rule ain't so bad after all. 0% interest rates and slight deflation. What is so terribly wrong with that? Well, the economies that are sitting at the bound have in fact had less output and inflation volatility than the ones where the central banks are doing all this shock offsetting all the time. Maybe we didn't get any shocks, but maybe that situation isn't so terrible after all.
Okay, good. Question in front of you, then I'll have the panel give a couple of answers.
Thank you.
We'll take a couple here.
Just one quick on John and one quick on Monika. John, first, I thought fascinating paper. I thought it was also particularly neat how you derived this adjustment with the R star and the Intercept. Very nice. One thing, this was all rational expectations and commitment. Mm-hmm. And this made me think back, other people have been mentioning their own papers. So at a short note in the AR papers and proceedings with Günter Köhn in 2004, where we looked at exit strategies from the zero bound. And we looked at price level targeting. Mike Woodford was pushing for that. We were looking at, Lars Svensson's exchange rate fixing, or QE, Orphanides and I had been writing about. And as soon as we introduced a lack of, or some learning about the inflation objective or the price level objective of the central bank, basically the benefits of these commitment approaches disappeared, while something where you actually have to do something today, like with QE or with the exchange rate, you can prove, your commitment more. And this, by the way, may have been, you mentioned, there was a big change with forward guidance. If I look at the European case, we had forward guidance also happening because the ECB said, look, we're going to keep buying and then we keep buying less and less. The QE itself reinforced the forward guidance. So, how do you show what you do? And quickly on the European experience with negative rates, I think there are two things to consider. One is that there are legal constraints also in terms of the regular bank accounts, whether you're, the legal contract that is. And then you hit the households indirectly, because when they have large deposits, or when they go through pension funds, investment funds, those are the ones the banks negotiate with to have a negative rate.
So Monika, do you want to try that? And then we're going to let John cherry pick of those questions which he wants to answer.
So I think whatever it is that gives rise to these zero deposit rates that banks pay, we need to understand what they are to think about optimal monetary policy, because we're in designing optimal monetary policy, it's going to be important what the constraint is. And if it's legal, it's interesting. If legal restrictions restrict deposit rates on small accounts, let's say, and not on large accounts, that is interesting. That will affect the design of monetary policy. In thinking about what's optimal, that's certainly going to matter for that. That was the only point.
So so first of all, I want to connect Krishna's comments and Volker's comments, which I think are very much on point. So I think what we've learned is that John should be doing the dishes every day, and then if he does that every day, then his commitment to do it in 5 years will be more credible. I think so. We should start with that. But the more I think that what we're trying to do in this paper, by the way, is not, now I'm going to respond more seriously to John, is we're not selling price level targeting. I mean, actually, what we're showing is trying to show the mechanisms by which it works. And so so 2 points I'd like to make on that. One is, it does work, it has a positive effects on these positive, inflation shocks where you undo that. The Snickers bar will always be $1 kind of thing. And some people think that's a positive or negative, but that is a part of the feature. So it's good to point that out. But I will say that one of the advantages of the Reich and Williams, so if I'm leaning anywhere, I'm leaning to my own papers, is that the commitment is not a perpetual commitment. I mean, it is in a general equilibrium expectations, rational expectation sense. But the way this model works, and the other papers have done it, after a lower bound period, you do lower longer for a matter of quarters or a few years, and then you've spent that buildup, and then you're back to normal. So it's not working off the way that, as you correctly point out, some of these forward guidance puzzles work, that you're promising things way, way, way off in the future. The promises are more immediate, but they still are promises.
Okay, I saw a couple of questions here. We'll take all three in a row. We'll end with Bullard as the third question.
Yeah, hi, Bob Wenzel with economicpolicyjournal.com. Mike, it's a two-part question. The first part is, in Paul Volcker's memoir, he wrote, "I puzzle about the rationale. A 2% target or limit was not in my textbook years ago. I know of no theoretical justification. It's difficult to be both a target and a limit at the same time. And a 2% inflation rate successfully maintained would mean the price level doubles in little more than a generation." And the second part of my question is, how high above the 2% target would you be comfortable with given current economic data?
Take the second question behind you. Then we'll go to Jim, and we'll let these guys cherry pick.
Yes, thanks. George Selgin from Cato. My question is related to John Cochrane's, but it's I think I may be putting a similar point as him, but in a different way. And it begins with the observation that it seems to me that your framework makes the lower bound problem seem a greater problem than it might actually be. And at the same time, by doing that also misrepresents the virtues of some of the different policies. I specifically mean the assumption there in the objective function that a constant inflation rate is ideal. So just to make this concrete, let's suppose you're right at the lower bound and it's not binding yet, and you have a positive supply shock, right? Now, that's a problem in your model because it's not possible to lower the policy rate, and so you're going to have lower inflation because there's more goodies being produced. Well, so if in fact you discard that assumption of having to have no volatility in the inflation rate and maintain a constant long-run inflation rate, then you just say, well, goods get cheaper because there's more of them, and bygones are bygones, and we're done. And that is, in fact, what an NGDP target would do. It wouldn't say you have to make up for it later on. It would just say if you have a negative supply shock, then you would have to let the price level rise. That's a different result, though, than of optimal result than you would get in your model, because it assumes an optimal constant inflation rate. And I wonder if you could comment on this observation, because I think it's related to John's. I don't think it's quite the same, but you could get a Friedman rule out of it if you pushed it into growth rate space.
So let's, there's a lot there. Jim will take the microphone, but the panelists could try to answer those two questions, both about the importance of 2.0% and then how high it might want to go beyond that in the making up for the past misses.
Right, so first of all, the 2% wasn't just pulled out of the air. Obviously, part of the discussion both in the U.S. and in central banking across the world was a recognition of lower bound type issues, measurement issues where inflation is likely to be, well below the measured value, and trying to get a good somewhere in between. In terms of our model, and you look at the work by Bernanke, Kiley and Roberts, and the work that Dave Reifschneider and I have done, you don't overshoot inflation by that much during the good times. It depends on the model and the caliber, everything about it. But you're not, because you're trying to get the mean inflation at 2, and you're basically going to overshoot by a few tenths, not percentage points. And so I think that some of the worries around average inflation targets are you're going to aim for 3 or 4% during good times. In fact, at least based on the historical experience, you're talking about a relatively few tenths. So let me give you a concrete example. Last 10 years, core inflation in the U.S. has been running about 1.6% on average, despite the worst shocks, hopefully, or worst recession of our lifetimes. So that gives you an idea that even in that case, inflation, the miss on inflation isn't that huge even in this episode.
And let me briefly add to that. So what the dynamic rules here show is that you, during normal times, don't need to run inflation that much above target anyway, because what's really the key factor here is that you increase inflation expectations during time when the lower bound binds. And you can achieve that with the dynamic rules by having higher inflation right after the lower bound period ends. And then during normal times, you don't really need to overshoot the target by all that much.
Right. Okay. Jim?
Yeah, Jim Bullard, St. Louis Fed. On the changing the inflation target, I like John's comment about it's become an international standard. And I think for the U.S. to move off that international standard would set off a global race, and I think it'd be a bad thing. So that's one of the biggest arguments, I think, for sticking with the 2% target. And then on Volker Wieland's comment, and for researchers in the room, there'd be a lot more to do here, because if the central bank really wanted to do this, you'd want to know what the transition looks like to the new regime, and there might be things happening during the transition that we don't like or don't understand at this point. And you could do that either under rational expectations or under some kind of learning assumption, and that would be interesting, I think. And my final comment is, what about nominal GDP targeting? This is a full model. It has an output gap and everything. Are there interpretations as nominal GDP targeting? Are you just not calling it nominal GDP targeting, or what is your view on that?
So I gotta have fun on this one, because yes, you have to understand that my opening remarks should have said, thank Thomas for doing all the work, and I should be blamed for any of the mistakes in the presentation. So nominal GDP targeting is literally an extension of the model that we're working on now. I think on the price level aspect, many of the things we found will carry over, but there are, as was pointed out, some differences. So that's part of the agenda. It's a little bit more complicated, so working on it.
So we enjoy eavesdropping on the FOMC discussion, but let me just, with our last 30 seconds, push you a little bit on Jim's comment about the regime change. So let's say that at the end of this period and study in Chicago, you adopt a new inflation regime, and it's for some future point. How do you communicate and feel comfortable that that future regime doesn't find its way immediately into expectations, both for markets, households, and businesses, as you're shifting regimes at periods that, as Jim suggests, might be a little bumpy?
Well, luckily, we got Rich Clarida in the room, who's running this project. No, I think these are relevant concerns. First of all, what should the decision be? Does the current regime work well? What modifications are appropriate or not? How do we communicate that? How would we have the transition and all of that? I think those are all relevant concerns, and obviously we know at the Fed that markets are very sensitive to this issue. This is something that we've hear a lot about. I do go back to this something that both Andy and Ken said earlier. And I'm not talking about the lower bound. I'm sorry, I'm not talking about negative interest rates. But if you really buy into the story that the neutral real interest rate is something like 0.5%, not only in the U.S. but in Europe and Japan and many other countries. If you buy into this idea that the lower bound, at least for now, until we figure out maybe other solutions, is a binding constraint on the central banks, and for some of the reasons that Monika, I think, highlighted, then we need to figure out a good strategy, a framework, a strategy, and an implementation for this during these times when the economy is in a relatively benign place. We need to prepare for this. We need to get some of the that transition and all of that done so that we're just in a better position when the next recession or whatever shock hits to achieve our dual mandate goals. It really gets back to making sure that monetary policy can be effective at achieving our goals in a future situation. And what exactly that entails, we're going to be discussing over the next year, and then we're obviously going to have to work very hard on explaining and communicating anything that may or may not come out of that.
Thank you, Hoover. Thanks, Monika, Thomas, and John for that. We're now off to lunch.
Great.